1.7% year-on-year, and taking the total converted users delivered in the full year to 105.3 million. Our tech-enabled, platform-focused innovations as part of Affle 2.0 strategy played out really well in FY 2021. We successfully integrated our platforms, teams, and IP portfolio to unlock innovative vernacular consumer experiences and deeper verticalization across key customer segments. We also augmented our mobile OEM and operator partnerships to power an open internet connected ecosystem play. This has further strengthened our consumer platform and enabled greater ROI impact for our advertisers. Our efforts towards enhancing our human resource capabilities and building on-ground local presence in some of the international geographies are also paying off very well and driving traction for the business. Affle platforms have been consistently recognized in the industry as top performers and were recently awarded 51 wins across categories and geographies in the latest edition of the Affle Performance Index 2021. Affle continues to also be recognized as a great place to work by the Great Places to Work Institute in 2021. We take pride in our values to build an inclusive culture that boosts innovation, collaboration, learning, fun, and entrepreneurship. We thank all the investors and shareholders for their support to our strategic fundraise process. We had an approval to raise rupees 1,080 crores, of which we decided to allocate rupees 600 crores in QIP. We see this underpinning our growth and global expansion plans while we continue to evaluate credible inorganic opportunities that shall further enhance value for all our stakeholders. We also remain in deep gratitude to our teams whose endless support, even in COVID times, led to our all-round consistent performance. Affle has been highly responsive in ensuring its employee safety and also contributed in well-governed COVID relief funds to support the community at large. With that, I hand over this discussion to our CFO, Kapil Bhutani, to discuss the financials. Thank you, and over to you, Kapil.
Thanks, Anuj, and a very warm welcome to all the participants on the call. Wishing everyone a good day and hope you all are keeping safe and well in this COVID times. Continuing our year-on-year growth momentum in financial year 21, the company reported revenue from operations of rupees 5,108 million, a growth of 54.8% Y-on-Y. Our Q4 revenue stood at 1,416 million, a growth of 76.9% Y-on-Y. Our EBITDA for the year financial year 21 increased by 46.4% Y-on-Y, while the Q4 EBITDA increased by 63.4% Y-on-Y. Although the third quarter in the year is the highest quarter due to bigger seasonality driven by festive season, and therefore Q4 and Q3 sequentially will not be a good way to analyze. However, if you just compare the OPEX sequentially, our overall OPEX has come down. Our employee cost sequentially was stable. Our data inventory cost in Q4 was at 57.4% of the revenue from operations versus 57.9% in Q3, and in line with the Q4 last year. Our minority investments have done well. We have exited IndusOS while continue to be invested in Talent Unlimited, that is Global AI. We recorded a gain on these investments in Q4. Pursuant to the introduction of the Finance Bill 2021, we had one-time tax expense as deferred tax liability on goodwill amounting to 11.52 million in Q4 and 14.18 in financial year 21 due to change in the tax base. To provide clarity on our business operations, we have normalized profit after tax to mention one-time items in our earnings presentation uploaded on Stock Exchange and company's website. Our normalized profit after tax for the year was rupees 1,031 million, an increase of 57.4% Y-on-Y. Our profit after tax for quarter 4 was 265 million, an increase of 73.6% Y-on-Y without adjusting one-time items as discussed in our PPT. Our profit after tax, without discussing our adjusted profit, without adjusting our profits for the one-time expenses, our profit after tax would have been much higher. We remain focused on working capital management, and our collections have been robust through the year. Our cash flows from operations was 1,030 million for financial year 21, a YoY growth of 43.4%, and adjusted operating cash flow to PAT ratio was 100%. With this, I end my presentation, and let us open the floor for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Hardik Sangani from ICICI Securities. Please go ahead.
Yeah, hi. Hi, everyone. So just a couple of questions. So in terms of the newer privacy changes, for example, in cohort-based advertising by Google, so what is the possible impact that can come towards in terms of advertising as a whole in a general industry, and if there is an impact on how we do our operations? Secondly, just wanted to get a breakup of organic and inorganic revenue on YoY basis in Q4 and overall for FY21. And thirdly, sir, so in terms of investments by the QIP which we have raised, so are we looking in specific segments to enter into? Yeah, that's it from my side now.
Thanks for your question. I will take some parts of the question and let Kapil complete any parts that I'm not addressing for you. So with respect to whatever Google is doing, I think we have already mentioned before as part of several conversations that we are not a direct competitor with respect to Google. In fact, on the contrary, most of the advertisers typically split their budgets for advertising on digital very differently, marking certain parts of the budget that go to Google or Facebook or their related networks. And the teams who are looking at those budgets are also typically different from the teams that are looking at the non-Google, non-Facebook part of the pie. And the non-Google Facebook part of the pie continues to consistently grow. And most of the analysts, even in developed markets where digital advertising is a much bigger part of the total advertising pie, have already clearly opined that the non-Google Facebook part of the pie is in fact growing at least as fast, if not faster, than the overall digital advertising pie. So we are also seeing similar dynamics in emerging markets. And in fact, we are also partners with Google. The advertisers who are working with us can take some parts of their budget and take some of the Google and Facebook budgets and channel through our platforms to deliver conversions overall. So I think we have absolutely no issues or concerns with respect to whatever Google and Facebook might continue to do, as every platform should continue to innovate and evolve. I think at this moment we are absolutely fine with coexisting, and the addressable market is very, very large, and it's always been the case for the last 8 years. I think the dynamics in the markets are well settled, and we are not kind of head-on competing per se with Google or Facebook in this market dynamics. The third part of your question, which is related to QIP and strategic investments going forward, we are definitely showing that as a company we have delivered on a successful track record of doing not only M&As but also minority investments. And we are extremely prudent in how we manage our investments, integrate them, and turn them around from where we acquire them to becoming much more profitable, much more growth-oriented companies powered by our tech and IP integrations with them. And so this is a very clear formula for us to continue to grow our company, and the QIP was also premised on that for not just inorganic growth, but also organic growth and expansion plans of the company. So we are looking at expanding into new geographies and also doubling down on our 2 V's and 2 O's strategy in existing markets. And as and when we find the right target companies, and there are many that we have always been evaluating, and we have always had very long courtship periods with any company that we have actually invested in or acquired. So at least 2 to 3 years of long courtship period before Affle actually signs the dotted line. So, we have a mature pipeline, and as and when the right deal dynamics emerge and we find the appropriate candidates, we will do the, disclosures and announcements for the inorganic plans. In terms of the mix of revenue, organic to inorganic, I think the last year has been a phenomenal success for us on all fronts, and we have, I'll give a qualitative answer and let Kapil give the quantitative one. So qualitatively, we have put every single business that we have, every single business unit that we have on a strong growth trajectory, and also ensured that on a, per business unit basis, we are able to ensure profitability and cash flow positive, performance. And that I'm very, very proud of, because, when you acquire companies and you will turn it around, I think we have consistently shown a very strong track record on that front. Now over to you, Kapil, to, give some specific numbers, perhaps, with respect to this quarter on organic versus inorganic.
Thanks, Anuj. For this quarter, we have about 18% contribution coming from inorganic, and about just above 7% to the PAT contribution from inorganic. This is contribution of the AppNext acquisition, which was done last year in June. MediaSmart was there in the previous quarter, so it is organic. It is a part of the organic growth.
Okay. And just one follow-up question to that. So Q4 is typically we experience a greater decline in the past. So in this quarter, actually, the seasonal effect has been quite lower. So any specific reason for that?
Sure. Let me take that, Kapil. Let me take that. So actually, the October, November, December quarter is typically the highest quarter for any advertising company business. We are no different. And if you see the last 3 years' trends in our earnings presentation, you would see that this is a consistent pattern. Now, October, November, December is in 2020, because of COVID, was also a little bit more balanced out. I think we shared that in the last earnings call as well, that, of course, the advertisers put bigger budgets in that time because of Diwali and Christmas and school holidays and so on. But, this year they balanced it out a little bit between Q3 and Q4, and that was anticipated, and this is what we are seeing at this moment. But having said that, I think the overall growth momentum of our business in Q4 has been really strong on all parameters. Consumer platform business, CPCU, non-CPCU business, existing markets and new markets. I mean, it's been all-round positive growth. And that's why in Q4 you see the CPCU growth is over 80% on the number of conversions that we delivered. And that's really, boosting our confidence that, look, everything is going well across industry verticals, across existing and new markets. And, I think we should just see it on a standalone basis or Q4 to Q4 basis for a deeper comparison, and not really spend too much analysis on Q3 versus Q4 for this time.
Yeah, sure. That's it from my side. Thank you.
Thank you. The next question is from the line of Rishit from Nomura. Please go ahead.
Hello. Hi, thanks for taking my question. So congrats on a decent quarter, first of all. Now, just a couple of questions from my side. First, on the growth in the next year, right? How do we see growth in the next year panning out, right? Will it be, because some of these markets will start to recover in terms of spending, right? We've got some of the international presence that we've started to invest as well. So how do we see the growth between international and India, one, between mass and retargeting, second, and what are the key drivers in each of these markets that you would sort of attribute for the next year? That's the first question, and I'll ask the second one later.
Thanks, Rishit, for that question. See, typically I've always stayed away from giving, short-term guidances, but the outlook for the immediate next year as well as for the next 5 years is extremely optimistic at our company. Let me give you some macro insights on that, and then I will drill down further on our specific situation. In terms of emerging markets, specifically in India, the total mobile marketing spends as a percentage of the total advertising spends is roughly around 20-odd%. If you look at the developed markets today, most of them, the mobile marketing digital spends are already at 50% of the total advertising spends. What does that tell us? It tells us that we will see a similar pattern or an accelerated pattern of growth because of COVID situation as the advertising spends in emerging markets, India as well as others, move from the 20-odd% of the total ad spend to 50%. And this will definitely happen in the next 3-odd years, is my opinion. Now, given that opinion, our outlook is extremely optimistic, right? Because the advertisers have no choice but to spend on mobile and digital smartphone connected devices in order to get the attention of the consumers. The consumers, on the other hand, have actually accelerated their adoption curve, right, with respect to all kinds of lifestyle services across our categories E, F, G, and H, which are e-commerce, entertainment, education, financial services, food tech, FMCG, government, gaming, groceries, healthcare, and all of these categories contribute over 90% of our revenues. The adoption of the consumers on these categories is going to continue to increase, and they will do more and more conversions, new conversions, repeat conversions, online and offline conversions, and so on. So we will see all-round, very balanced growth across all of these parameters. Now, in terms of specific clarity, right, ever since we went public or even prior to that during roadshows, I've always consistently committed that we will deliver at least 25% CAGR growth over the next 5 years. And I've always been asked, as the base keeps changing, Affle has grown substantially since IPO over the last 2 years. And now with this new base, are we still saying commitment to, year on year as well as CAGR growth for next 5 years above 25%? And the answer to that is a firm yes. So I would see 25 to 30% CAGR growth for our company over the next 4 to 5 years. And that's largely anchored on the fact that the macro factors are playing with massive tailwinds and lifts for our business for the continued momentum to be delivered, especially across emerging markets. In terms of India and international, your specific question to Affle, where the balance is right now about 50-50%, we see that India will also continue to grow quite nicely, and international markets would grow not only in line and ahead of the average growth trends in those markets, but also because we are relatively smaller in those markets and the number of geographies is quite a number. And we are a global platform. We have no restrictions in which geographies we can deliver business in. Of course, it takes time to go and build teams in those markets. But one would say that going forward, the shift should be in favor of international markets growing faster, possibly in the 60-40% range as we go through the next year or so, and find a certain balance over time. But, every time I think of that and I model that for our company, I'm also surprised by how quickly, how deeply we are able to grow within India on vernacular verticalization strategies and eventually end up with a better balance in favor of India. So, I would say that long term, whether in the next few years or so, the balance will shift in favor of international, and that should certainly happen. I hope that answers your question. And if it doesn't, perhaps we will take it up in other questions as they come along.
No, it surely does to some extent. Just a little more on that one, right? What are the other geographies from an international market that we're planning to get into? That's one. And then within those geographies, right, we'll be much smaller in terms of presence, right? What are the two or three geographies, right, key ones that we sort of planning to become much larger in terms of size, where we could have a dominant presence similar to where India is today for you guys? Any color there should be helpful.
Yeah, in terms of emerging markets globally, we think that in a matter of time, we have the right full business plan and business model and technology and team-based differentiation to establish, number one, number two, or, the top few kind of market leadership position within most of the emerging markets globally. All right. So that's how I see Affle's strategy. India, we're already there. Let's make sure we achieve that in Southeast Asia, Middle East, Africa, LATAM, and, this will be both organic and inorganic, and we must make sure that we execute on that focus on emerging markets. But as we do that, we're also seeing very interesting opportunities to enter into very interesting niche positions in developed markets, right? And whether it's North America, Europe, or Japan, Korea, and so on. So I think we are placing very calibrated bets, and we are seeing a global opportunity for our business where market leadership in India should give us a very clear right to establish market leadership across all emerging global markets, because India is one of the toughest markets in the emerging markets in the world. And if we are able to do that here, absolutely no reason why we cannot do that in all other global emerging markets. And it will go in sequence: Southeast Asia, Latin, Middle East, Africa, in some order. In the next few years, we should be able to achieve that. And we are also not leaving developed markets out of our purview. We're just saying that, okay, in developed markets, we're not trying to get in there to become market leaders, but let's go and, very niche certain verticals and segments, let's make sure that we're giving the more established players in developed markets a run for their money, because we are exceptionally competent to deliver business in developed markets as well.
Okay, and that will be largely, the developed market strategy will largely be driven around App Next, Media Smart, essentially, and not around mass, I would presume. Is that the case, or is that will?
No, not the case. See, every of our platforms, and capabilities is equally relevant globally. I mean, it's not that some platforms are only for emerging markets and some are for developed markets, but we may deploy a different strategy. So when you go in, let's say, into a new market, we may choose to enter with a particular set of strategies and weapons, let's say, versus another. So we will always optimize and say, let's go in with one, and then everything else follows behind it. And those execution strategies, I will not want to limit ourselves on which way we go first. But all our platforms are given the prioritization that let's dominate emerging markets, and let's also keep a corner of the eye view on developed markets and execute on them, as the case might be. But we're not limiting any of our platforms from the global possibilities that all these platforms have. And we have deep execution capabilities. And if you look at our management team, we have a very global management team. It's by no stretch of imagination, limited to any particular geography.
Okay, fair enough. That was very detailed. And just the second question that I have was on the risks, right? So I think the couple of risks, right, around privacy, around how Google and maybe iOS change their policies, right, on the unique IDs that they sort of put out, and then how they change how apps have to sort of collect data, etc., and keep notifying the users, right? How do you see the ecosystem changing and responding to that, and how are we placed in terms of investments? Because I look at some of these players like in Mobi, right, which one of the competitors, right? So what they try to do is they try to get into a more data strategy, that they try to own the data by, let's say, getting into products like Glance, etc., right? What is our strategy, and how do we think we are placed in that ecosystem? Thanks.
Sure. So first of all, we have to look at the fundamentals of the business model that is already at play. Whenever advertising is happening on digital, it is almost always happening at the benefit of the consumer getting a service on an app or a website, either free or subsidized, right? So that's the reason why the consumers would typically opt in. Now, whatever iOS and Google are doing, they're just basically saying that we need to ensure that the users are opting in much more clearly, and they are being informed much more clearly by each of these apps, which are saying that we will deliver ads to you. So the opt-in has to be done properly. And we are very well supportive of that as a industry, that to progress, that, hey, the consumer should know, why am I giving consent or not? Now, all of us as individuals on our phones would have seen that when you're using an app or when you land on a website, it says privacy statement, kindly accept, kindly move on. And I mean, 99.9% of the times, if you want to access that app, you just want to, quickly accept it and move on. And that's the behavior pattern of all consumers. What we're also seeing in the US is that on iOS 14, and we have some business in the US, and we're able to take some of the data that we have and sample it on a, statistically valid sample size to see that a good number of consumers are actually giving consent for a good number of apps and services. So I think the ecosystem will fundamentally need to go back and say, are the consumers willing to pay and therefore not give consent and not see ads, or are they going to give consent? Now, here, the most interesting point is that the developed market consumers will behave slightly differently from emerging market consumers. I can tell you that any sample A/B testing that we have done, emerging markets, India, or any other emerging market in the world, if you go and offer somebody, hey, this is an ad-subsidized app, versus if you reject the consent, they're going to get a more expensive version of it or something, the consumers in emerging markets are more than willing to give the consent. We are not so stuck about, hey, hold on a second, this is my data, where are you taking it? Of course, some segments would be of consumers, but a large segment is not. And once the consumers give consent, then it's business as usual. The consumers who don't give the consent, there are other ways of behavioral targeting as long as you have statistically large enough samples of users whose data is being processed through the system. And if you are able to run your algorithms, you can say that, okay, if user A is behaving in a certain way or a device A is behaving in a certain way, and I have no data on that, right? No deep data on an individualized basis, but I have some cohort-based broad analysis, then we should still be able to do meaningful sort of advertising on that, on those devices as well. So at the moment, I would say that we are not seeing any dramatic changes in emerging markets happening because the iOS impact is very low in India, in other emerging markets around the world. And Google hasn't really followed behind iOS so quickly. And I would think that Google will probably take another 2 to 3 years or more before they follow on iOS 14. By then, we should have already built a fair amount of adaptation with respect to these changes. So I don't see any immediate impact. Otherwise, I would have not been so optimistic about my forward guidance, for next 3 to 5 years. And very importantly, our OEM and operator strategy adds another layer of defense on this because the OEMs and operators have a lot of autonomy with respect to Android devices, especially in emerging markets. And when we partner with them and make them a stakeholder in terms of the monetization possibilities of advertising revenue in this ecosystem, then we get a lot more sort of deeper insights. In terms of gaining access to data, so like you said, InMobi is going after doing something like a glance and working with OEMs for one of the products in one of the ways. I think and they are more going in the content way, right? They're going more into like the TikTok path with Roposo and so on. And I think what Affle has done instead is we're going deeper on the utilities, like the keyboard, for example, right? And we're going deeper on investing in that and owning in that and monetizing that and therefore gaining deeper insights. Now, let me give you one simple insight. A keyboard on a device is used more than 120 times by each of us on an average per day. Across every single app that you have on your device, the keyboard must show up. But the -1 screen or some other sort of content screen, that's very limited touch point with that. I mean, even if it is somebody is viewing that video content for 15, 20 or 30 minutes in a day, that is still a very, how do I say, one context of the experience. Whereas the keyboard is used across all kinds of contexts of the EFGH categories or even more. And therefore, our approach and strategy on that front is actually very sound with respect to vernacular verticalization deeply within India as well as elsewhere. So that's the reason why I have continued investment in, Babel. And these are just some insights into our strategy, and we're executing very deeply on our 2 O's, OEM and operator partnerships, and 2 V's, the verticalization and vernacular strategy for emerging markets. So I think we have a very, very good handle on where things are heading and a very clear strategy to continue our growth journey.
Thank you. Before we take the next question, a reminder to the participants. Please limit your question to 3 per participant. You may come back in the question queue if you have a follow-up. The next question is from the line of Manisha from GC Capital. Please go ahead. Manisha, you may go ahead with your question.
I'm unable to hear Manisha in case she's on mute.
As there's no response from the current participant, we take the next question from the line of Mridul Shah from Amara Capital. Please go ahead.
Hi, Anuj, Kapil. Congratulations for a fantastic year. Anuj, my question to you was, how do you see the ad tech market shaping up in the broader sense, especially with respect to the efficacy around the targeted marketing? And obviously, the privacy issue you had answered in a previous question, but still wanted to take your thoughts. Do you really see the digital ad space market continuing its effectiveness? It might sound weird, but in one of the articles I was reading, they were comparing the ad space market, the digital ad space market, to the subprime crisis of 2007. Any thoughts on that? How do you see this shaping up in the broader sense?
Yeah, I think the writing to me is very much on the wall with respect to the two macro factors, that the advertising must only happen where the consumer attention is. And the consumer attention, you would never be able to disagree with me, even as an individual, is deeply on the smartphone connected devices. We are not watching any other medium, TV, print, radio. I mean, any other medium is falling short by a mile when you compare that to digital consumer attention on digital connected devices. And especially when you see it from the lens of two particular consumer segments. One is the youth, right? From my daughter who's 6 years old, they have no interest in anything but a connected device, from media consumption point of view. Or when you look at rural audiences, because of affordances, they will say that this is the only device that they would invest in and use for all forms of lifestyle, business needs, as well as personal entertainment or consumption. So there is no doubt in my mind that the advertisers have no option but to spend on digital advertising. Now, the efficacy of digital advertising with consumer privacy taken care of is a very sensible balance that needs to be achieved. And the government's acted on that. Right? They said that there needs to be data privacy laws. There has to be Personal Data Protection Act. It started in Singapore. It started in Europe. It started in US. Even there, the consumers had a regulatory right to give a consent or to withdraw the consent, and that consent was being managed on a broad basis. And now iOS 14, especially impacting more developed markets, has said that the consent has to be much more explicit. And all of these trends have already been behind us. I mean, more or less. I mean, iOS 14 is still, the verdict is to be, seen and to be out. But I think for initial trends that we are seeing, this is not going to stop the advertisers from spending more of their digital spends or more of their advertising spends on digital. And it's certainly not going to stop the consumers from using the services that they want to use without paying for it by consenting to take ads. So I think I'm reasonably confident on the macro factors. In terms of how exactly will this pan out and, what will happen with Google and Facebook. See, Google and Facebook are in a bigger sort of an issue, if I may say, because they are advertising companies later, but first and foremost, they are consumer services where they are directly taking a lot of data from the consumers. And they are always under the radar, whether it is from regulatory perspective or, frankly, if I may say, iOS 14, what Apple is doing is much more targeted on Google, Facebook than anybody else. So I think the competing forces as well as regulatory forces are going to trim or contain the availabilities or abilities of the larger players in the market, and the rest of the players will become beneficiaries of that, right? Because the budgets would spill over in greater favor of the open internet ecosystems, and that's why you're seeing in the US, which is the largest digital advertising market in the world, there's so many listed companies in the space, and the analysts and all of them are super bullish on that, even with 50% of the market being exposed to iOS 14. So, I think I rest my case there. I think the macro factors are supportive. And in emerging markets, it's very Android heavy. Google is a completely digital advertising sort of business model focused company. They're not going to do something that will derail this business ecosystem. And in partnership with OEMs and operators, we also de-risk ourselves substantially from anything that Google might do on its Android platform, because when you partner with the OEM, you get on-device insights, which doesn't necessarily require Google's permission per se, right? Because it doesn't go through the Google Play Store ecosystem all the time. So I think this is how we are keeping ourselves fairly balanced. I've been running this company for 16 years, and I've seen. I started Affle in 2005. Before Google, before Apple launched anything to do with Android or iOS respectively. Nokia was king, BlackBerry was cool, and we've seen massive shifts in the ecosystem. But what we have not seen any change with is the consumer adoption for mobile devices has only grown, and the advertisers' adoption has only grown. So what happens in the middle with the rest of the ecosystem may fluctuate, but Apple is extremely grounded in our entrepreneurial resourcefulness, and we know how to maneuver and deliver value and growth in this ever-changing ecosystem.
True. Fair point. Completely agree. Just a quick follow-up on that. So let me ask you from the other side. What does give you sleepless nights? Do you fear any technological disruption, or do you see any new synergies coming into play? How do you see, what gives you sleepless nights? Sorry for asking this question. You can choose to answer in as less words as you want.
Well, I deeply care about my team and people, and see, the numbers are ironically for our business, COVID, no COVID, is always growth oriented and strong, right? I mean, there's no doubt in my mind that we will continue to deliver, financially strong performance. But what I care deeply about and not able to solve for my team is when their families are unwell, when my team members are unwell, and how do you lead in that time with empathy, with concern? And I think that has been causing me some unsettledness and feeling of sometimes you just have to surrender because not everything you can control, and just because you're the CEO or the leader or the chairman, you can't solve every part of the puzzle. Some things you just let happen and just pray and hold on to things. And so we lost one of our colleagues last year, and that got me really impacted. And I think this year we've lost so many family members of colleagues. We've had no loss of any Affle employee, but a lot of family members have been impacted. So what I'm coming down to is, as a culture, how can we be as a thriving culture where we take care of our team, carry everybody together as stakeholders, not just help them in their career growth, but also in the wealth creation journey. And I'm extremely grounded on that, right, in terms of sharing and carrying everybody along together, right? So you see that throughout COVID, we didn't have any cost cutting or something that would be unfair to the employee stakeholders. And instead, if you see on the OPEX side, we consistently make sure that bonuses, appraisals, everything is going on time. In fact, we're going and, paying advances to people whose families are affected and so on, giving, loans from the company if need be. So that culture of the organization is what I deeply care about. So today we are almost 400 people strong across so many geographies, making sure that when people are not coming to office, how are they still feeling connected? And so I'm really deeply invested in making sure that we build a very solid culture of togetherness and care, so that people know that if you stay at Affle, when Affle is growing, we will all be growing together, and our families will be safe and taken care of.
Right. That's great to hear. Thanks, Anuj, and wishing you and the team all the very best. That is all. Thanks.
Thank you. The next question is from the line of Vikash Mistry from Moonshoot Ventures. Please go ahead.
Okay, Anuj, I have two questions. First one is that I want to understand about connected TV strategy, which actually is quite exploding, and revenue from them are increasing much faster than mobile advertisement, and how we are trying to tackle that.
Sure. So on your first question, the comment that you made is largely true for North America as one of the leading developed geographies, and it is not entirely true yet for emerging markets like India and so on, where connected TV is at a very nascent early stage, and Affle has already launched its product and propositions and partnership strategy for connected TV already. It's very, very early stage, but I think we are watching that space very closely with an emerging markets, India specific and other emerging markets specific lens. And I'm very comfortable with where we are on the space, so we're not reacting to it in any delayed fashion. We've been proactive, we are early, and we are investing in that space as well. So I think very, very comfortable with that. I do see it as a long-term growth story even in emerging markets. But unlike in developed markets where it is on the bigger TV screen, the connected TV, I think we are still going to see a lot more mobile-based consumption of OTT as the variant. So there's multiple ways on how you define connected TV, and I think this is a massive opportunity for growth, and we are eyeing it and investing in it holistically, and we're on top of the game. We have a dedicated team which is just looking at that, so we should be just fine.
Okay, that's helpful. Next question is on your data costs are quite higher as compared to global peers because we are using CPC method. And going forward, would you think that with operating leverage and as algos and data richness will increase, can we hope that the lower data cost will happen and as algos become more efficient?
See, the data cost in any emerging geography will be relatively higher, and I'll tell you why. Because we have a much larger population in emerging markets. We have a higher per capita usage of mobile apps and devices in emerging markets versus revenue, right? So the unit economics of, let's say, what is the value of one user's conversion in India versus the one user's conversion in North America. Now, then compare that to, okay, what is the average data being generated by a user in North America versus an average user in India? You'll find that the per capita data generation in India is larger than the per capita generation in developed markets. And that's because, data plans are cheaper. People have, a lot of time. There's a lot of people and there's a lot of time. This is in developed markets, relatively speaking. The cloud computing costs, right? The servers cost on, let's say, Amazon Cloud, Google Cloud, or Microsoft Cloud, they don't say that, if the server is or data is coming in from Indian devices, they're going to charge us lesser for processing on bandwidth and server processing power compared to, if the data is coming from anywhere else. So when you talk about large, scalable, humongous volumes of data, especially India, and on low unit economics of revenue, I think when you take it in context, you'll find that Affle is exceptionally competitive and has a really, really strong unit economic model here delivering profitability, which, by the way, is a big competitive advantage when we go into developed markets because, we will find that we are getting paid more, our cost is lesser, our profitability could be higher, but, we have chosen to fight the battle various reasons over the last 7-8 years in emerging markets, and we slowly open that competitive advantage in developed markets as well over time.
Okay, last question from my side. That we have done acquisitions of MediaSmart and AppNext. They are somehow newer businesses where our ROAS are quite low, and we have improved them beautifully by their margin expansion and all that. So what will be our strategy going forward in terms of acquisitions? Whether we are going to buy out some mature businesses or trying to buy out some Salesforce kind of acquisitions or something capability kind of acquisitions?
I have already shared multiple times that our inorganic growth plan is grounded in... Yeah, go ahead, please. Yeah, I've been talking for too long.
We have seen our acquisition strategy over the period of time. We have acquired more technologically focused, but geo-focus was the second reason. But as we go forward, the geo-focus would be main dominant factor for us. Then the technological factor, because we have all the ingredients in our tech platforms at the moment. And I would not like to elaborate more on this at the moment because we have stated that this is going to be a way forward strategy also. With limited information being given to you is that we'll be more geo-focused than the technology-focused.
Okay, that's helpful. Thank you.
Can we move to the next question?
Hello, operator, we can't hear you. In case you're on mute, could you, guide us to the next question, please?
Hello?
Since we're not able to hear anyone, it seems that the
Hello,
operators...
are you able to hear me?
Yes, we can hear you now. Go ahead.
Thank you. The next question is from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Hi, thank you for taking my question and congratulations, Anuj, on a great year, great FY21. Thank you also for the clarity on the iOS and Android privacy issues that you elaborately put forward. Just extending to that, I had three questions. One is divided into two parts. Part A is basically, do you see the accuracy of mobile advertising reducing over the next 2-3 years as more and more privacy norms are released? As you said, Google will take another 2 to 3 years to reach that stage. So do you see the accuracy of these ads reducing, thereby impacting our realizations or increasing the acquisition of data costs? This is my first question.
All right. So the short answer is no. I see that especially in, first of all, I must say that based on the way our business is calibrated, anchored on emerging markets, we are deeply Android skewed. Okay. And in that sense, we are also very, very insulated with respect to what is happening in iOS 14 in developed markets specifically, because iOS has very little exposure or market share in emerging markets. And so we are deeply insulated from those changes, and that gives us a huge advantage and privilege because we are able to analyze what's happening in iOS 14, and we can build models, predictions, action plans with respect to what might happen on Android if this were to be done in a few years' time on Android as well. Now, Android and iOS are very different ecosystems because iOS is completely in the control of Apple. Apple can make any change that they want. Whereas in Android, Google has to work with OEMs and handset manufacturers because each of them have their own varying levels of control and autonomy with respect to what they do on their devices. Now, Apple is already deeply partnering with operators and OEMs across emerging markets, and therefore we are making sure that we have much deeper sort of capabilities and insights with respect to any future changes that might come. The second difference between these two ecosystems from a larger emerging markets versus developed markets perspective is that the consumers, people like you and me, are much more amenable to giving consent and having a cheaper ad-funded experience than, let's say, in developed markets. There would be more proportion of users who would say, no, I'm ready to pay, but I don't want to see the ads. And I think in that sense, in emerging markets, I expect much higher percentage of consent versus in developed markets. And therefore, once the percentage of consent reaches a certain statistical threshold, then it doesn't really matter because our system doesn't work necessarily on each individual device. It actually already works on aggregated insights, because you'd be surprised, you and I may have never met, but you and I might be behaving so similarly on our mobile connected devices. So there are basically a few hundreds of consumer segments and patterns which most people conform into. And as long as you can gain that level of statistical valid, sensible capabilities, then the systems would basically work and perform and would not see any efficacy issues. So I hope that answers your question. I'm pretty confident that the changes on Android and emerging markets will take quite a fair bit of time to happen. And even when those changes happen, the OEMs and operators would have a say, and we in partnership with them would have an ability to gain deeper insights. And finally, the consumers there will be enough and sufficient statistical sampling of consumers who will be giving consent because of the fundamentals of achieving a cheaper ad-funded service versus a non-consented, non-ad-funded premium service. So I think, I'm not so nervous, and I'm definitely not losing sleep on this particular point.
Thank you for this answer. My second and third question are regarding what would be the latest employee count, and when will the next wage hike cycle be? And the third question is regarding the finance cost. It's slightly spiked in this quarter, so if you could just throw some light on that. And last, thank you for the detail on the AppNext acquisition. If you could just give the EBITDA margin profile in this quarter. That's all from me.
Kapil, let you answer these three questions on employees and any appraisal cycles as well as the finance cost and EBITDA.
So as Anuj mentioned, that we have 400 plus employees around the world today. The major appraisal cycle will happen in October. We had shifted the appraisal cycles last year for unifying it to October. We had two appraisal cycles earlier. We have now unified it to the October cycle. But anyways, there would be some minor employees who have got a small percentage of employees who have got increments in the April cycle also. So you will see that effect in the Q1 also. On the question of EBITDA margins, the EBITDA margins are about 18 to 20% on the AppNext side.
And the finance cost, please.
Okay, on the finance cost, there are two elements to it. The financing was taken by the company to do an acquisition of AppNext last year, which was about $10 million in Singapore. That was disclosed last time, and the cost is coming from that side. Secondly, the contingent consideration which is to be paid over a period of 3 years on these acquisitions are discounted for fair value and present value, and the cost is reflected in P&L. This is a non-outgoing cash, but this is accounted for as cash as an interest item for the present value of the liabilities due for in future, more than 2 years.
Okay. Thank you so much and best of luck for the next year.
Thank you. The next question is from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yeah, hi. Most of my question has been answered. Just one question, if Anuj could give any clarity on, is the inventory rates and eventual CPCU rates in the domestic market. Are we seeing any uptake, downtake on these parameters? Our check suggests that inventory rates in general are going up. So are we getting commensurated with higher CPCU on an incremental basis? And secondly, the impact on Apple's action in the non-India market. Of course, we understand the India being largely Android market, but overall exposure for us on the Apple's action.
Right. So first of all, on the CPCU rate, you can see that we have been holding steady, and our strategy is very clear that we are going for volume and scale and growth, because when we do that, we automatically derive certain efficiencies along the way. And we're not trying to change our CPCU price too much and giving, higher ROI outcomes and benefits to our advertisers across industry verticals. In terms of the inventory rates, I don't see, as far as we are concerned, this observation that the inventory rates are going up. That I don't believe is true. And we have leverage because we are a larger player in emerging markets, so we will be able to continue to keep our margin profile intact. So, other international markets as well, if you notice that our business is disproportionately focused on emerging markets, and we do very little business in developed markets. So the exposure on iOS would be not more than 5 to 10%. And even on that 5 to 10%, because we are so small in those spaces, we do believe that we have already got the necessary innovations and initiatives to keep our customers continue to spend on iOS, because the consumers are not going off from iOS, and the advertising budgets still deserve to be spent on iOS. And there is also an opportunity that if any advertiser is trying to switch iOS to Android a lot more on their advertising budget, then again we are quite strong. So we can either switch them from iOS advertising spends to Android in those markets, or find ways to upsell more, because we haven't sold enough in developed markets yet. So I don't see us seeing any material impact with respect to iOS 14 changes. And in fact, on the contrary, we might even be growing better than some of the other competitors who are deeply seen as iOS 14 developed market players, versus we are seen as experts on Android from emerging markets, and our solutions can be sold much more aggressively in developed markets, especially when iOS becomes a little bit of a doubtful area. In case the advertisers are rethinking, we have a better chance of winning larger budgets for Android there. So we should be fine. I'm not nervous about it at all.
Yeah, and lastly, Kapil, you can give any data in terms of the subsidiaries or the acquired entities. What are the revenue run rates? Just the big bookkeeping ones.
Can you elaborate your questions further?
Yeah, I mean to say, any revenue we want to give on the acquired entities, it could see entities, MediaSmart, Affle, and Discover.
So the quarter for the Affle is about 3.5 million, and the quarter four for MediaSmart is about 1.5 million.
And Discover?
Discover Tech is negligible at the moment. We don't expect, as previously told, we expect revenues to flow from Discover Tech. Those are pre-revenue company, pre-revenue acquisitions, and we expect the revenues to flow from Q3 onwards.
Right. And lastly, if I may, on this Indus OS kind of a transaction, have we received all the money, and any rationale we would give in terms of why we have exited this right on buying it back in just matter of 2 months of doing the transaction?
So as on Indus, as we had briefed it on our previous earnings calls also, the reasons for exiting, we had kept it because we anticipated a certain growth and realization of certain profits in this investment. And we believe that it is the right time to exit with the rights and the kind of valuation we were getting. And we have exited and made the profit where we think that this is the optimal thing to do at the moment. The rationale was provided in the last call that we are seeing this as more as now Affle India was seeing this more as a financial investment, and we as a strategy are more strategic in nature. And as and when we thought that the gains are enough for us to realize, we have done that.
Okay, but what was the urgency of exiting the rights as well? I mean, we kept it for 1 year and 2 year option. So you're just saying that the price was too good to catch up on?
Yeah, the price was good to catch up on. And as we move and build our cash for future growth and investment, I think we realized on the timing and as well as cost and benefit analysis.
Right. I mean, the reason for asking this is, of course, we made a strong money on the overall investment. There's no question about it. But when parent entity is based on media article is acquiring more stake in the same company, I don't understand the difference in we thinking about the potential of the business versus what the parent is thinking about the same business when they're acquiring at much higher price and much higher stake.
As answered, Affle's investments are more strategic for furthering the business cause, right? And Affle Holdings may invest for financial gains, right? So we have opportunities to deploy money in more strategic regions also. So we have paid our gains versus the potential deployment for the further times to come.
And we don't see.
I think it will be fair to mention that if Affle Holdings is doing any investments, it's it's their own thesis, it's their own sort of decision, and in the Affle India earnings call, it would not be appropriate to let's say discuss that or allude on it. But it would suffice to say that the holding company and the promoter group is deeply invested in Affle India and would not do anything which would harm Affle India's interests. In fact, on the contrary, any strategic possibility with any other company that Affle Holdings may have invested in would 100% accrue to the benefit of the listco. So as far as the listco is concerned and Affle India Group is concerned, we must make sure that our financial and strategic interests are always kept intact. And as far as Indus OS transaction is concerned, the financial interest has been fully realized and it is material, and therefore the board decided in its favor. As far as any strategic spillover effect or positive effect, Affle India would continue to be the beneficiary of that if it were to ever come with respect to any investment that the promoter group may have done.
Yeah, appreciate it. Just to continue the same thought, any comment you want to say on Bobble AI, how this investment is shaping up, and what are our strategic thoughts on this investment?
Yeah, so Bobble AI is doing really well, and we are very bullish and confident about both the financial as well as the strategic gain that Affle India Group would derive from it. And we are very happy with this investment and are looking forward to continuing it for the longer term.
Much appreciated. Thank you and best of luck for the time ahead.
Thank you.
Thank you. The next question is from the line of Devang Bhatt from ICICI Direct. Please go ahead.
Hi, sir. Thank you for taking my question. I just wanted to know, this quarter our organic growth was approximately 45% YOY. So are we being conservative in saying that we might grow 25-30%? Secondly, our FX margin are still at 7%. So when do we expect to reach the company level margins? And in Q1, some states were having a ban on e-commerce selling non-essential. So any impact of that or any impact of employee absenteeism on Q1?
Kapil, do you want to take this question, please?
Yeah, I'll take the first question. There is no employee absenteeism. Yeah, we had a stress of people having or their families having affected in the month of April. But as of now, the employee strength is fully back, and this impact was more so with the employees based out of Gurgaon rather than any other part based in India also. Can you repeat your question because it has three parts?
Okay. And any impact of that non-essential ban for e-commerce?
Yeah. So we have not seen any major impact which is material during this period. Yes, there some adjustments would have happened during the quarter for the budgets allocated, but we are not. There is no indicator to us that there will be a major shift in strategy at the moment.
And the next margins, when do we expect to reach the company level? Secondly, probably as per my okay, sorry, I'll ask later the second.
No, I'll just give you the answer. On the Appnext margin, you have to realize that when we acquired this was almost a neutral company, and we have got the company in 1 year has turned around and very favorably. We have to be a little more patient before because for higher margins on this. For the reason that it is more targeting on the OEM and operator strategy, which would need a larger time frame to reach to what the overall company level is. Right. So we have been able to successfully turn around the company to an acceptable level for year one, and we want our investors to be a little patient for year and a half for seeing better results on Appnext side.
Okay. And this quarter, as per my calculation, your organic growth is 45% YOY basis. So are you being conservative in seeing that only 25 to 30% growth or?
We are not conservative as previously stated. We have always said around 25%, and the statement this year has changed from 25 to 30%. So there is an indicator of the confidence we have, that we are still measuring the long-term impacts, how it will pan out before giving the firm guidances going forward. So we would like to reserve the guidances for the next few years based on the current trends.
Okay. Thank you. Thanks a lot.
Thank you. The next question is from the line of Ashwin Mehta from Ambit Capital. Please go ahead.
Hi, thanks for the opportunity. So Kapil, two questions from you. One, in terms of capitalization for development of platforms this year as well as this quarter, and how do you see that going forward? Secondly, in terms of, well, Anuj, you talked about the growth expectations of 25 to 30% over the next 5 years. What are our margin aspirations as we see possibly higher international growth, which should be accretive? And over this period, you also see some catch up in terms of your investments in Appnext and all catching up in terms of margins. And the third question was in terms of the platform as a service offering. So how has the take up on that been for us? Thanks.
Kapil, you want to take the first one on capitalization. I'll take the second one on margin and growth, and then the third one we can talk about.
Thanks, Ashwin, for asking these questions. My answer would be that we are on the similar lines as last quarter. But yes, we are rushing on certain initiatives to complete it faster. So the investments have been little higher in Q4, and it will be little higher in Q1. We are trying to close our initiatives by Q1, Q2 for a larger growth and taking the tailwinds which are there to be more effective for us. So we are rushing in to complete the projects a little faster. And with that effect, there is a slight increase by 10% on capitalization from Q4 to Q3. From Q3 to Q4, we had about 1.4 million capitalization in Q3. It is about 1.55 to 1.6 million. And we are just rushing and investing so that we can take advantage of the situation at the moment, which is making us very bullish for the near term.
Thanks, Kapil. In terms of our overall, growth and margin expansion possibilities from the businesses that we already have, right? I mean, in terms of the organic growth, we are very clear that every acquired business that have already been successfully integrated over the course of 2 years or so, we will be able to bring it to similar levels of bottom line and margin efficiencies as our, organic business has been. And we have already demonstrated that over time because with, fair number of acquisitions, we are consistently performing, not just in terms of growth and, pricing, CPCU, margins, and, bottom line performance has been quite resilient overall. And going forward, as volume of business grows, right, we would expect that to also continue. But we have to be seen as a growth-oriented company where we are also consistently investing not only in our tech platforms, but we are also investing in on-ground presence across new geographies and so on. But even with all of that, I do expect that we should be able to achieve a similar track record of continued performance. The only criteria that you need to be watchful for is that when we have further inorganic acquisitions, we will again have those same cycles of acquiring companies that are perhaps not as efficient and acquiring them as value-based transactions and then transforming them with our tech and capabilities and efficiencies and processes a much higher level of value creation. So, and there is always going to be that gestation period. So let's say we do another acquisition in a few months' time, and then we turn it around over the next 2 years. When we consolidate that together with us, you will see the bottom line margin, on an adjusted basis that, hey, organic business is performing in this way, the new acquired business is at lower margin. So it will be more mathematical modeling that hopefully the analysts of the various investors would be able to do as and when we do further acquisitions. But on the organic business clearly, and the businesses that are already acquired and integrated, we're already well on our way to deliver great efficiencies from profitability and cash flow positive execution there. And your final question was around
the platform as a service offering.
That's right. So on platform as a service offering, we have been very clearly watchful, and we have got some good success and some early proof of concepts, where we are in discussions with customers, but it's not material yet. It is still going in the omni-channel and enterprise side of the non-consumer platform business at the moment, and we are, carefully evaluating that opportunity. I see a big possibility there, including in developed markets. But given our execution-focused sales teams' relationships with customers are in emerging markets, we're already trying and talking to several customers, and there are early proof of concepts that we have already done with some of the customers. So it's positive, but it's not a substantial part of our revenue mix at the moment.
Okay. Thanks a lot, Anuj. Thanks for your insights.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question for today. I would now like to hand the conference back to the management for their closing comments.
Great. Thank you, everyone, for joining the call today and for all your questions, which were very insightful. And I hope our answers have given you a comprehensive understanding and insight into how the outlook for our business remains extremely optimistic and bullish based on the macro factors of consumers adopting and converting more on digital connected devices, as well as the advertisers spending more, especially in global emerging markets where Affle aims to be a market leader as we continue to keep our execution focus there. And also having the adjacent opportunities in developed markets where we believe our platforms and management have, capabilities to compete there meaningfully. And, so all round, when you look at on the balance of things, Affle remains focused on sustainable, continued cash flow positive, profitable growth metrics, and we hope to unlock great value for stakeholders. 25% to 30% CAGR growth on next 5-year broad basis on a larger base that we are at today is a conservative but an important commitment from us, and we will continue to execute on that business plan and deliver growth and value for all of you. Thank you very much for joining today, and stay safe.
Thanks, everyone.
Thank you. On behalf of ICICI Securities Limited, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.